I'd like to introduce Julia Coronado and Karen Dinan, who will be speaking on changing retirement behavior in the wake of the financial crisis.
Thank you very much, Linda. So setting the stage here, the financial crisis has, of course, been associated with a tremendous deterioration in household balance sheets. Going into the crisis, they had these high debt loads, and then we saw these enormous plunges in stock prices and home prices, and a little bit of some recovery in stock prices, really no recovery in home prices. And the result has been, this is one way to see it, this is household net worth relative to personal income. It fell sharply between late 2007 and early 2009. It's recovered a bit since then, but as you can see, the current level really is as low as it was in the early 1990s. So digging in further to look at households by age group, and what we're really interested in here is the group, the 55 to 64-year-olds, because they're the ones who are approaching retirement. What you can see is that those older households, older workers, were very vulnerable on the eve of the crisis. So this is information from the 2007 SCF about asset holdings. You can see in the first panel that these guys had high ownership of equities. They had high median holdings. It was a high fraction of their total assets. In the second panel, you can see that they also held a lot of housing and had high median levels of housing. And as a result of this, actually, despite accounting for 17% of the population, they actually held stocks and houses disproportionately. They accounted for about a third of stock holdings nationwide and about a quarter of housing held nationwide. And so what this meant is that they were very vulnerable to the declines we subsequently saw in house prices and stock prices. They really kind of felt the brunt of these developments. And indeed, this is data on median net worth. You can see it very clearly. The gold line, the top line, that's the 55 to 64-year-old group. And I should say the last data point is from the 2009 SCF. For those who've been following it, you know that we don't have the microdata for that survey yet, but the Fed has released recently some sub-aggregates by age group. So what you can see is that the 55 to 64-year-old age group saw the largest decline in median net worth, and it put the level of net worth by late 2009 back to where it was about 10 years earlier. So what we're aiming to do in this paper is to explore how these changes in balance sheets have affected household behavior. And theory tells us that there are three channels that we might see effects. And the first would be a decline in consumption, increase in saving to make up for the losses these households suffered, maybe also for precautionary reasons because they perceive an environment of greater uncertainty. Also possibly an increase in labor supply, perhaps most pointedly through deferring retirement age, again to replenish that stock of wealth, and also maybe changes in their financial behavior, maybe a more conservative financial behavior in reaction to maybe a greater perception of risk out there. And there are different ways to tackle this question. One way is just to ask households what they're doing. And I'll talk about that in a minute. A lot of literature to date on this question has actually used that approach. A second way to do it is to do a deep dive into household level data on the question and look for cross-sectional patterns of balance sheet developments and subsequent behavior. But what Julie and I are doing in this paper is a third approach, which is really a complementary approach, which is to really try to look at a broad set of what are largely macro indicators to try to put together a narrative of how we think households have responded to these developments. And relative to these other approaches, it's a complement to the surveys, which are telling you what people intend to do or hope to do. But as we know, actions can be different than intentions. And relative to the household data, the macro indicators allow for maybe more breadth in terms of what you're looking at, and also certainly more timely data and data with higher frequency. So here's what the survey says, just quickly. How the evidence on whether people are cutting back consumption, increasing saving, that's a little mixed. I mean, we get hints in the data of households wanting to tighten belts, yet a lot of households are saying they haven't really changed their contributions to their defined contribution pension plans. A lot of the surveys are pointing to households deferring their retirement age, and there are hints in the survey data of households engaging in more conservative financial behavior. So let me just start by talking about consumption saving patterns. We know the aggregate saving rate has risen. Julia and I turned to data from the Consumer Expenditure Survey on what the consumption patterns were for different age groups. And what we've done here is we're looking at non-housing consumption. I don't want to use the housing consumption because that's really entangled with wealth data. But we're looking at the change from the business cycle's peak to 2 years hence. And we are comparing that to the last recession as a way of trying to isolate the effects of these unique balance sheet developments. And what you can see in the last column is that the second to last row of the first panel, you can see that these older households cut spending aggressively relative to the other age groups. You can see a pretty big cut for the younger age groups. We did a little digging into consumption by category, and what we think is going on there is really a credit story. And this chart just shows you that the declines for the younger age groups have been concentrated in durables, vehicle spending. Those are really the credit-sensitive categories. And for the older households, what we're seeing is much more of a broad-based, across-the-board cut, consistent with this idea of belt tightening. So with that, I'll turn things over to Julia.
This slide that Karen has left up there is quite striking. Again, there's a lot of discretionary adjustment going on for those older age groups. And I think one of the ways to reconcile that with the survey data where, say, a lot of people say, no, I didn't increase my contributions to the 401k. Well, okay, maybe you didn't, but the way you increased your saving was just by spending less, rather than actually setting aside increased amounts of income through your 401ks. There's a lot of ways you can achieve saving, and clearly both the aggregate evidence and the this more granular look also suggests that there's been a lot of changes on the consumption side. On the labor supply side, there's a lot of difficulties here in isolating this. And in general, what we're doing here, it should be stressed, we're not making any definitive identification of behavioral parameters here. What we're doing is saying, what does the data tell us? Is it consistent with the adjustments that people say they're making? Is it consistent with the adjustments we think that they would be making? Looking at aggregate data is fraught with identification issues, and certainly that's true when we're looking at labor supply behavior. So what this table does is it looks at what happened to different age groups in terms of their unemployment rate. So what was the magnitude of the shock that each group experienced, and did older workers get hit harder? And then how did they respond in terms of labor force participation? And again, doing the same kind of difference in difference approach, looking at how this cycle compared to the average of prior post-war cycles. And actually what you see, certainly everybody got hit really hard in terms of the labor force. The unemployment rates for all age groups rose significantly more than prior cycles. I mean, it was bad all around. And in fact, it doesn't look like older workers or workers approaching retirement did worse than their younger counterparts. To the contrary, really, young adults in some sense got hit the hardest in terms of unemployment in this current cycle. So they fared poorly, but they didn't fare quite as badly in relative terms. But then if you think about it from the life cycle perspective, of course, the older worker has much less time to make up for that lost income than the younger worker. And this, I think, shows through in the labor force participation rates. In general, labor force participation rates decline during recessions. There are simply fewer opportunities, and people go back to school or stay home with a child or climb Mount Kilimanjaro. They do other things because the opportunities aren't there. But what we see is that the 55 and older group actually increased their labor force participation significantly. And that is in contrast to prior cycles. So, the identification issue here is intense. There is a secular upward trend in labor force participation rates. There are other ways you can get at this, but certainly the surveys suggest that this is the easiest margin people have to adjust, and the aggregate data do suggest that there has been a lot of longer working lives as a result. In terms of financial decisions, there's going to be a lot of papers at this conference that are going to dig a lot deeper. People that have proprietary data that can look at actual account behavior. I'm looking very forward to seeing that. I look a lot at the aggregate data, being a macroeconomist, focusing on the implications of all of these decisions for the outlook for the U.S. over a longer horizon. I'm always looking at the aggregate data. And this is a chart that the New York Fed put together, which I think is very revealing, and it just shows that people's borrowing behavior has been affected. There's obviously supply issues here. There's tightening credit standards. There's also the reduced demand for consumption leading to reduced borrowing. But nonetheless, households are borrowing. I think this slide is a more definitive look at behavioral decisions. These are mortgage refinancing transactions. The proportion that are cash out versus cash in. And the proportion that are cash in, that is, the people who are doing the mortgage refinancing paid down at least 5% of the principal through the mortgage refinancing transaction. Rose to 40% in Q4 of last year. It's a phenomenal statistic. Now, of course, part of this does also reflect higher standards. Many people have lost equity in their homes. If you want to get the lower rate, oftentimes you have to put up more equity if you want to refinance. But the fact of the matter is people are choosing to do so. Which means you do a complex calculation where you're thinking of the saving that you're going to get from your reduced mortgage payment, the foregone use of that cash that you obviously have. You have some cash in order to pay down 5% of your principal. You're choosing to do that rather than invest in equities or credit or whatever it is that you think you can return that you can earn on your savings. You're willing to put it into paying down your debt on an asset whose value is still declining. Okay, that is, to me, is a striking choice. Time is up. I'm wrapping up. Okay, and this is where I'm going to roil up some of my my colleagues on the asset management side here, or actually, I'd be interested to hear what they have to say. These are mutual fund cash flows. The net inflows into fixed income funds has been phenomenal. On the order of certainly on the same order of magnitude as the inflow into equity funds in the 90s. People are getting out of equity, and the outflow hasn't been as huge, but the marginal choice has been to put your money in fixed income. And it's been across the board. It's been into inflation index bonds, it's into government bonds, it's into corporate bonds. So there really is a perception that, okay, I'll take some risk, but I want it to be limited risk rather than the kind of equity risk that people suffered through. So quickly wrapping it up, I think it's the statistics that Karen showed on the concentration of the hit on older workers, to me, is very striking. Really, it was the pre-retirement households that just got slammed by what happened, and so are really bearing the brunt of the behavioral adjustments. And it was more really, and we have this more detail in our paper, it really was more a story of just collapsing asset values rather than necessarily leverage, over-leverage, and vulnerability to over-leverage for these older households. They weren't the most leveraged, but they did have most of the assets, and the values just collapsed. And so they're left recalibrating their entire plans and their entire life cycles. The data are consistent with the surveys, and this is of macroeconomic importance. And this is just to say, we're sort of taking a backward-looking, summing up what are lessons. This isn't over, okay? The house price adjustment is still going on nationally. House prices have been falling for the last 9 months after a brief period of stabilization. This is not just in California and Las Vegas. This is everywhere. So households are still facing uncertainty. The Fed is printing money. I think that's a great idea. Don't get me wrong. But nonetheless, is that equity rally that we've seen real, or will that prove transitory as well? I think these are the decisions that households are still facing. The uncertainty is not over, and I will now wrap that up. Only a few minutes over.
Thank you.